You need to separate your personal and business credit as an entrepreneur. There's all kinds of bad things that can happen. Thanks for joining our training today. By the end of this training, I'm going to teach you everything that you need to know about separating your consumer and your commercial credit. We're going to talk about a lot of hidden problems that a lot of entrepreneurs don't know about that can adversely affect you if you don't do this. We're going to tap into some of the knowledge from the biggest experts in the space, from SCORE, SBA, et cetera, and talk about why they insist the separation of consumer and commercial credit is so important. And we're going, by the end of this training, you're going to understand kind of the roadmap of the things you need to do to get down this path of separating your consumer and commercial credit for many reasons, including the fact that you're not liable in your business for what happens personally. It's all going to happen in this training. Let's dive in. So first of all, let's take a look real quick as a reminder of what business credit is. We're talking about with business credit, it's basically the credit capacity of a business. Actually, it's probably one of the best descriptions I've really seen of it. It's independent of the business owner. So remember, consumer credit, commercial credit, it's the only way we can legally separate our credit profiles. So hence your personal credit and your business credit scores can radically be different as well as they are. We'll talk a little bit about credit scores today. But we've got a lot of other training on our social channels about what you need to know about all these commercial and consumer credit scores. But when you're building business credit correctly, then what happens really is you're protecting your personal assets as they're never put on the line. But it's not just protecting assets, guys. It's protecting your credit. The problem is that you create a lot of damage to your consumer credit that then prevents you from getting like all kinds of other business financing you could get by trying to use it to muscle your way into money where business credit was designed to do. So when you do this perfectly, it's just everything starts to fall in line. All this resistance you start to run into to get money for your business kind of goes away, because now you're leaving your consumer credit to do the stuff in your business you really need to do. And then you're able to build your business credit, and that carries the majority of the weight for qualification for funding that you're getting for your business. But you've got to be able to build a business credit profile for this to happen. You have to be proactive and actually build a commercial credit profile and score in order for that to happen. We're going to talk about some steps on what you need to do with that as well. So when business and personal credit aren't separated, then for the most part, it's really just your personal credit. And that's what happens. For business owners that don't build a business credit profile and score, well, then your personal credit is basically the equivalent of your business credit. Now, there's a couple issues with this. First of all, the issue is that if you have bad personal credit, well, that's obvious. Now your business has bad credit because you have no credit for your business. Your personal credit becomes your business credit, right? So now your bad credit personally is affecting your ability for your business to access money where it shouldn't. But even if your personal credit is good, the problem there is that you're using your personal credit in areas it's not supposed to. You're adversely affecting your utilization. You're adversely affecting inquiries. You're adversely doing things to your personal credit report that make it harder for you to use that for the things you really do need to use it for. Okay, and again, all this is just because you've already got a personal credit history. But if you don't have a business credit history, then your personal credit kind of becomes what's used moving forward. Okay, and again, a lot of lenders then are going to latch to that personal credit because there is no business credit established. So I hear this from a lot of people. I say, look, I'm starting a business. I don't have cash flow, and I have bad credit, and I don't have collateral. And this is what I say. I say, look, if you don't have a business strength to make you lendable, then you must create one. And that's what business credit does. It creates a strength for your business to help you actually get money if you don't have another strength. Now, there's a lot of reasons to build business credit. Even if you have all strengths, cash flow, credit, collateral, it still helps you get more money at better terms. But if you can't get money because you don't have cash flow, credit, collateral, business credit becomes another asset. It becomes something that helps you get money. And this is why I often say that when you build business credit the right way, business credit can be used. Your business can basically fund itself. You don't need to rely on your own personal credit in order to get that done. Now, Maria says, hello, I would like to work with you. Where can I go to sign up? All you have to do is you can go to creditsuite.com. Our enrollment options are right there. You'll see at the top of the page, I think it says get started, something pricing, something like that. Or you can also give us a call. You're entitled to a free consultation with us, 877-600-2487, 877-600-2487. There's our number. Give us a call and we'll talk to you more as well. We'll go through your business credit reports for you, get your business credit reports for you for free, and do a free consultation and talk to you more about your options. So give us a call. That number's on the bottom of a lot of our slides. And I appreciate that. I look forward to working with you, Maria. And Dane says, whenever I catch the live, it turns out to be a good day. I appreciate that, Dane. I'm glad that I'm the one that controls whether you have good days or bad days. Okay, so if you do absolutely nothing to build your business credit, then your business doesn't have an EIN, a credit report. Now, maybe your business does have an EIN, but again, maybe you've never built a credit profile for that EIN. And you also wouldn't have a DUNS number, okay? With Dun & Bradstreet, you wouldn't need this if you're not building your business credit. With neither of these, there really is no business credit. There's only personal. So you have to keep in mind that if you're going to build business credit, you've got to have an EIN. You've got to have your DUNS number. These things start to happen and unfold that make you a legitimate, credible business. And see, that's the problem, guys, is that 90% plus businesses fail. Okay, it's insane the amount of fail. And it's also insane the percentage that ever get to significant growth levels. So less than 0.5% of all businesses that are ever founded in this country, for example, ever get to like $10 million. And I think like less than like 2 or 5%, somewhere in that range, ever even get to $1 million. Think about that. Of all the businesses, 600,000 businesses are created in the United States every month. Of those, less than 5% ever even do $1 million in business. So these lenders and credit issuers are desperately trying to figure out who they want to give money to. And so that's where they've developed all this fundability criteria, including business credit, to determine and separate the ones that are real novices, that are startups working from home, that really don't do much in revenue, and the ones that really legitimately can be 7-8-figure businesses. So fundability is important, but business credit's really part of fundability. Having a DUNS number, having an EIN number, having a credit profile for your business, these are clear signs of legitimacy for lenders and credit issuers, and they help them kind of put businesses in different buckets. The bucket that they want to lend to, the bucket they don't. So if you don't have business credit established, you're going to remain for a long time in the bucket they don't want to lend to. By establishing business credit, you kind of move into this bucket that they do want to lend to, because you're starting to hit all these marks they really look at to see that you're fundable, to see that you're a legitimate, credible business. So according to the U.S. Bureau of Labor Statistics, only about 60% of all businesses survive to celebrate their third anniversaries, okay? So and a lot of them don't even make it to year 3. For 4 out of 10 businesses, 3 years or earlier is the end of the line. Of course, you want to make sure that your business isn't one of them. And again, the statistics get even worse. We know that, business failure rates are 90-95%. So when we look at 5 years, 4 years, 10 years, again, less and less and less businesses actually make it. So what happens if your business and personal credit are intermingled and your business actually goes bankrupt? Well, creditors will come through your company's assets to be paid first. And then they'll look at equipment, they'll look at land, they'll look at any assets they can grab, they'll seize inventory. They're going to take all your business assets first. And then they're going to come after your personal assets, just the way that it is. And I actually went through this presentation once, and I had somebody on stage at an actual conference, and somebody came in to me in tears and said, I worked for a collection agency, and what you said is so true. It broke my heart, because after we went after all the business assets, we went immediately after personal assets. We took stocks, we took bonds, we liquidated bank accounts, we went after cars, we went after homes, we went after all the personal assets, and we had the authority to, because they personally guaranteed those debts. So then the business assets are thoroughly exhausted. As I mentioned, they go through and they take those personal assets, your home, your car, your stocks, your bonds, your IRAs, and you don't want this to happen. Look, what COVID has shown us and what the mortgage crisis showed us is that, guys, stuff can come out of left field that we have no control over and completely shut down your business overnight. I owned a mortgage company when the whole mortgage crisis happened. We couldn't even close loans for like 6 months' time. So not having a business, you can't even sell your product and services for 6 months to a year. That's pretty devastating to a lot of businesses. Now in COVID, it's restaurants, it's bars, it's service businesses. There's a lot of retail businesses that aren't essential per somebody else's classification that were shut down overnight. I've got friends that started brand new bars that were raving. There were huge successes, and then overnight they're shut down with really no opportunity to even fix it. There's nothing they could do. I mean, they don't sell food. They have a license to sell food. There's nothing they can do, and they're shut down. So the reason I say this is so many things can come out of left field that can adversely affect our businesses that we really have to create the separation, this layer of protection against our personal assets, because even if we're phenomenal entrepreneurs, there's still a lot of stuff that's happening that we just can't control. So with no separation between business and personal credit, what happens is you basically get stuck paying the business debts personally. Even if you move to another industry entirely, unless you never, ever want to retire, you don't want this to happen, right? So I'll give you a real example of my world so you understand how this stuff goes down. I didn't understand business credit when I owned my mortgage company. Mortgage crisis came out of left field. We were scaling. We were leveraging business credit, or not business credit. We were leveraging business credit cards to scale. Okay. But the problem is I personally guaranteed all that. So mortgage crisis happened. Everything overnight stopped. We put all this money into DuPont registry and all these advertisements that were working really well for us, but we never got the return. We put the money into ad spend. We started to get the customers. We had the customers in underwriting. The whole thing shut down. All jumbo loans, everything couldn't get closed. Then we had all these expenses we went to get the new business, and none of the new business could close. So we started to default on those credit lines. We couldn't afford those payments. And then what happened was then they came after me personally. And I'll tell you exactly how it went down so you know. First of all, we had a Bank of America credit line. So what Bank of America did was they monitored my bank account through whatever means that they do. And then when bank account was at the highest point, the point where right when you get paid, right when money comes in, they grabbed every dime that was in that bank account. They cleared it out. They liquidated my account. They just removed the money. Like one day I was in there and there was thousands, and the next day there was nothing. And here's the problem. When you have a bank account, a checking account, what do? You write checks, right? All these checks outstanding. Well, all those checks started to bounce, right? My electric bill and all these things started to bounce because I'd written checks against the money that was in the account, and they actually grabbed the money right from the account. So that's what really happens. It's not like you go through some big court battle and then you lose and then they come take your money. In that case, Bank of America, they just came and grabbed the money. So again, you have to be very careful because that's the kind of stuff that happens when you personally guarantee things in your business. And all of a sudden something happens that's really kind of unexpected. Okay, Kenneth says, does inquiries hurt business credit? It doesn't. They oftentimes show on your business credit reports, but they don't adversely affect your credit score. And Jason says, hello, starting a new business and would like to know if an LLC or corporation is better to get max funding. Both of those are better. And in order, corporation's best, LLC is second to get you most funding. And both of those look very legitimate, make you look very credible. So either one of those you can't lose with, but you really want to consider a corporation. It's what's looked at the best from lender and credit issuer size. Talk to your attorney and accountant to hear their opinion. But from a lending standpoint, those are by far the best. Okay. And Patrick is coming in on a couple things as well. Okay, so what if your business beats the odds and is rousing success? Well, congratulations, right? Successful businesses need a lot of things. Business bank accounts, you probably need to get a true EIN at this point. You need to get set up so the IRS recognizes you as a real business. And if you don't have an EIN, well, then you have all kinds of tax auditing problems. And if you do have an EIN, well, then it's easier for you. Here's what I mean. A lot of us don't even know we can own businesses without EINs. Sole proprietors own businesses all the time without EINs. But here's the reality. A sole proprietor is audited by the IRS 1 in 7. Sole props are audited. 1 in 7. That's insane. Corporations, 1 in 50 get audited. So that's how much sole props are scrutinized. Not only are they looked at negatively by lenders and credit issuers, but you are really scrutinized by the IRS. 1 in 7 chance of getting audited versus a 1 in 50 if you're an actual corporation. So a big difference. Also, with no separation between business and personal assets, your funds will also be commingled. Okay. And that's all kinds of problems. If you ever get audited, which I've been audited before because I changed accountants and the new accountant didn't do the stuff my old accountant did to kind of make sure that there weren't red flags and protect me. And I can tell you it's a nightmare. Not only does it cost a lot of money for an accounting firm to represent you in an audit, but it commits, easily 50, 100 hours of time that you have to do. Every expense. So if you've never been through an audit, let me explain what happens. Every single expense you have, every one, 100% of the expenses that you claim on a tax return has to be verified 2 ways. First, you need the receipt. And secondly, you need to show where it happened on a credit card or bank account. Think about that. Thousands and thousands and thousands and thousands of transactions you do in a year. Every single one, 100% of them have to be accounted for with an IRS audit. For the bank statement or credit card, you have to show where the transaction took place. Then you need the receipt. And how many of us keep all of the receipts that we have? How many of us know where every transaction is going through every credit card or bank statement? It's 100 hours worth of your time. You never want to do that. And that's one of the reasons that you don't want this to happen. By being a corporation, by being an LLC, you limit the chance of audits. But if you commingle funds, have one bank account, don't have a personal, don't have a business, and you have these things crossing over versus commercial and consumer credit, the issue is if you ever get it audited, you're dedicating every bit of 100 hours and a lot of money, 10, 20,000, just to be able to answer and entertain the auditor, let alone everything you have to pay depending on what happens as a result of that audit. Now, new business owners may feel obligated to use their personal credit and personal guarantees to cover business expenses. But again, there's serious risk if you're trying to do so. The risk of using personal guarantees tends to grow as your business grows. But let's be honest, the most volatile time in a business is starting it up. So even though you don't have a lot going on, when you use your personal credit at the beginning of the business, that's when you're the most volatile. That's when most businesses fail. So again, that's when you're most susceptible to having problems defaulting and it adversely affecting your personal credit. Okay. And with growth comes bigger expenses and in turn greater liabilities. It doesn't get any better because as the business grows, the expenses grow, the demand of cash for the business grows. And if you're trying to use personal credit to fund it, then it kind of it creates this kind of downward spiral because you're used to using personal credit to feed the beast of business. And then all of a sudden, like the beast needs more. It needs more food. It needs more money. And then you're using even more of your personal credit to try to get the beast, the business, what it needs in terms of more money. So it just gets seriously worse when you start from the beginning using personal credit to be able to fund your business versus business. Now, using personal credit to cover business expenses add to your personal credit utilization. Your credit utilization is ultimately the percentage of the high credit limit you're using, and it goes over 30%. Your personal credit scores are really going to take a hit. Let's talk about this because this is kind of a myth. It's not actually accurate, but there is some real relevance to this, so I want to teach you. First of all, let's look at FICO score. FICO score, 35% of your score is how you pay. Do you pay your bills on time? Consumer FICO score. 30% of your consumer FICO score is your utilization. So 65% of your entire score is two factors, utilization and payment history. But look at the math a little closer. 35% of your consumer FICO score is how you pay your bills. 30% is your utilization. FICO is telling us that your utilization is mathematically almost as important to your credit score as paying your bills on time. That's not my opinion. That's math. 35% paying bills on time, 30% utilization. Those are pretty close. So FICO is telling us how important credit utilization is. And the problem is when you use personal credit to fund a business, it's not designed to do that. Limits are 1/10 to 100th in consumer credit of what they are for a business because a business needs more cash, right? We spend, I don't know, $100,000 to $200,000 on our credit cards every month for our business. I would never do that as an individual. That's the way we all are, is we spend way more for our business than we do as individuals, especially as our business grows. So the problem is if we try to use our personal credit to fund the business, our utilization is not designed to do that. And the minute we start racking up balances, then what happens is our personal credit scores take a hit. Now, here's what a lot of people say. It's okay. I pay it off every month. It's not okay. It doesn't matter if you pay it off every month. What matters is the credit cycle of the credit issuer, meaning American Express may show your balance to TransUnion, Equifax, Experian on the 17th. Chase might show it on the 10th. Okay. Bank of America might show it on the 12th. They all have different cycles of when they report that data to the credit bureaus. And so the problem is, even if I pay off my American Express card by the 30th of every month, that doesn't do me any good if they're reporting the balance to the credit bureaus on the 17th. What's happening is that my personal credit's still taking a hit even when I pay it off every month because I'm not paying it off in accordance with when the actual credit issuer reports the balance to the credit bureaus. And since every credit issuer reports it differently to the bureaus, there's no way to keep up with it. You can't know that Chase needs to be paid off on the 12th and Bank of America is on the 15th and American Express is on the 17th and your third American Express card's on the 19th. It's almost impossible to manage. So the minute you start using personal credit, your utilization is going to take a hit. Your FICO scores will take a huge drop. Guys, I've seen $120 increase on somebody's balance owed drop their scores over 100 points. I swear to you, I've seen it. I'll tell you why. They didn't have high limits on their credit cards. So $120 was a pretty big hit to a $500 limit credit card. And since utilization was 30% of the score and they didn't have a lot of other credit cards, it dropped their score of 100 points. They couldn't qualify for a mortgage because of a $120 increase to balance on a credit card. Okay, I've seen over 10,000 credit reports in my life on the consumer side. I can tell you that this is a serious problem. Now let's talk about the 30%. The reality is that any balance that you keep on a credit card adversely affects your credit scores, just the way that it is. The higher you get of a balance related to the limit, the more damage it is. When you get over 30%, you are flat out hurting the score. You are lowering the score and hurting the score because you're over 30% utilization. But the experts in the space, people like John Alzheimer that are on Fox News and everywhere that teach credit scoring, those are the gurus that have taught me. And John will be the first to tell you, you need to keep a 1% to 2% balance on your credit cards, nowhere close to 30% to maximize your FICO score. So utilization is a huge problem when you're commingling consumer and commercial credit. In addition, your personal credit score could take a hit each time that a report is pulled. And these are called inquiries. And here's the problem with inquiries. Okay, the way the inquiries work is that there are groupings of inquiries that adversely affect your credit score. If I go get an inquiry today, it's not going to necessarily lower my score. But if I get 3, 4, 5 inquiries in a short period of time, it will lower my score. But we're not just looking at how many inquiries we have. The FICO consumer score takes into account how many inquiries account or end up in real accounts on my credit report. So let's say I go get let's just say I get 3 inquiries this month for 3 business credit cards. Let's say those credit cards report on my business credit reports, not my consumer. Well, then FICO sees I had 3 inquiries and they see I have 0 new accounts because those didn't even report on my consumer credit report. That's the problem with this linking and using personal credit to fund a business, is that oftentimes you use your personal credit to get money for the business. The business money you get, the credit cards, the credit lines, the loans, don't show on your consumer credit report where you put the inquiry. And part of what drops your inquiry part of your score, which is 10% of your score, is the fact that you've got inquiries that don't end up in accounts in your credit report. This is why you never really should apply for anything unless you know you have a really good chance of getting approved for, because the more inquiries you have that do not result in end accounts, the more significant the damage to the FICO score is. A lot of people won't tell you that, but that's how inquiries actually really are calculated when it comes to FICO. So using personal credit to cover business expenses also can skew your company's debt to income ratio. This makes it more difficult for lenders and potential partners to get a clear picture of the business creditworthiness. Additionally, if you only use personal credit to cover business expenses, then other companies may access your incomplete business credit profile. This happens. I say it all the time. You've got to separate personal and business credit because anybody can see your business credit reports. Yesterday's training, I showed you when you go to get a credit report with Experian, Equifax, or Dun & Bradstreet, the first question they ask you is, do you want your own credit report or are you pulling a credit report for another business? So it's so easy for anybody to get your business credit reports that you don't want them to see an incomplete credit profile, an incomplete credit score, especially when you try to get business loans, credit lines, or credit cards, okay? So it becomes difficult for business lenders and credit issuers to see that you're paying people as agreed, and then it becomes very difficult for you to be able to get the loans and credit cards that you need. And one of my buddies, John, came to me the other day. He has a near 8-figure business. They do a ton of money, and they got denied for business credit quality. And he called me for flipping out. And he said, dude, I don't even understand this. I've got credit with all these media sources. And he started listing all these major media players. And I said, but John, none of those people that are giving you credit report the credit to the business credit reporting agencies. You're using personal credit to fund your business. You've never taken steps to build your business credit. So what you're saying, is it provable? It's not provable. The proof that lenders are looking at is they're looking at your commercial credit report. And what they're seeing isn't what you're saying. You're saying, I have credit with all these people. I pay them as agreed. They pull your business credit report. They see no credit. So remember that all these lenders and credit issuers, whether you want a car loan, whether you want a credit card, whether you want a loan or a credit line or a line of credit or a net 30 account, or you want to deal with suppliers, they all look at your business credit report. When they don't see history of you paying your bills as agreed, they look at you as unestablished. Even if you have paid other people, if that's not on your business credit reports, it becomes a problem. And think about it, it's the same way in the personal world. If I go to pull your personal credit report and there's nothing there, and I'm like, dude, you're trying to get a car loan, but you have no credit. And you're like, yeah, I have credit. I have absolutely credit. I borrowed money from 10 people around me, my friends and family, and I paid them all back. I pay them religiously on time. Doesn't matter. Doesn't matter. Because it's not anywhere where it's reported. Nobody's going to take your word for it. Getting receipts from your people, I'm not even going to worry about that as a lender. So your credit report is what reflects your payment history. If it's not there, a lot of lenders and credit issuers won't look at it. And John did not get the credit line he wanted. And it was a huge problem because here's what happened. It wasn't that he tried to get a new credit line. It's that they called due his existing credit line. So that means he had a credit line that he was using, and the lender pulls his business credit report, sees that it's not established, and says, you know what? We're going to call this line due. You've got 2 weeks to basically pay us back all the money that's on this credit line, and we're shutting it down. And then he's like, I have established business credit. So he tried to get a new credit line, and the same thing happened. So these are real problems as you scale. It can be ignored. It's the same as consumer credit. You can ignore consumer credit all you want to. But when it comes time to get a car loan, when it comes time to get a mortgage, all of a sudden that bites you and you're not able to get it. Then you have this process of establishing or fixing it that takes time to get the money you need. So you don't want that to happen. You want to try to get this as soon as possible, as soon as you start your business. So when you need to get the money that you need, your credit's already established. Okay, it's one of the best ways to be able to get that done. Okay, and somebody from Facebook says, been in business 11 years, didn't know much about business credit till last year. It's good. I'm glad you're learning. And Lee Dracus says, no, it really is good to have inquiry on your business credit report. It's not good or bad. It shows other people are incurring, but it doesn't help you or hurt you. So commingled business and personal expenses can give the wrong impression about everything, including your cash flow, your expenses. Still, a lot of startups, a lot of micro business owners should still expect lenders to request a personal credit as well, especially when your business credit's not established. Look, I talk about business credit all the time, but consumer credit's very important. A lot of lenders and credit issuers will look at it, but they're going to look at it less and less and less the more established your business credit is, period. It's one of the reasons you need to separate them and start building business credit. So incorporating separates the business and its owner into two separate entities. Okay. It's also, even if the business only has one employee, it still separates it. Bottom line, LLC is the same. Okay. It's really what separates you from the business. And that's important for many reasons, including liability. Again, I'm not an attorney and I'm not an accountant, and this isn't tax or legal advice, but it is the reality. The reality is that you need to separate the two to become more lendable and to separate your expenses, separate your liability. It's best practice to consult with a tax lawyer or tax attorney to get more advice as well. A truly separate corporation shields its employers from personal liability in a lot of instances. Felonies tend to be an exception. And we've all seen this before. We've seen companies on the news where the business does some really shady stuff and people get hurt or die as a result. Those CEOs still, a lot of cases, they get charged with felonies. They actually are held accountable for the actions of their business. So it doesn't completely protect you. If your business goes out and does stuff that's shady and kills people, then you're probably still going to be held liable as the CEO of the business. But for most of the stuff, let's talk about, that's so rare, right? But the reality of it is it does create some kind of veil. It really does help protect you, and it gives you some kind of veil between the actions of the business and its employees for, let's say, 99% of instances, beyond the rare instance where somebody dies or something serious happens. So if there's no good separation between the two, well, then that corporation veil is what's called pierced. And then what happens is they put you on the hook for whatever happens in the business. Then you become all liable, and then all kinds of problems occur. You know, we have a real blessing in the United States. And reading Arnold Schwarzenegger's biography, and it's phenomenal. It's huge. It's like 24 hours on Audible. I'm physically reading it. But it makes me appreciate where people come from. You know, I mean, he came from Austria with this house on a dirt road, you know, where people just live. I mean, they die to try to get to this country where we can start businesses and have these layer of protection between us and the business. And we can take these risks and make all this money. And then if we fail, you know, with the bankruptcy, the company can file bankruptcy and we still have these protections. We have these amazing opportunities here in the United States, but it's a real problem if you are the business, because then that corporate veil gets pierced because you don't even have a corporate veil. You don't have that layer of protection there. Now, I talked about why you want to keep the two separate. Now let's go over exactly how to do it. So incorporating, as already mentioned, partnerships, sole proprietors, not as much. So you really want to go into a corporation. It's one of the only real entities to actually truly separate your liability. Now, you can choose an LLC as well, but a corporation's preferred. Now, having separate bank accounts is the easiest way to prevent the commingling of funds. Many banks will require you have an EIN to even set up a business bank account. If you're strict about using your separate about using your separate business account for business needs, then it's going to be a lot easier for you to do so. Another reason you want to do this is that it opens up funding opportunities for you. Oh my gosh, merchant cash advances, business revenue lending, peer-to-peer lending, artificial intelligence lending, PayPal, Square, Stripe loans. They're all loans based on getting you money on how you manage your business bank account. None of that's available if you use a personal bank account for your business. None of it is. So again, guys, if you're getting value from this, do me a favor, hit the like button, hit the love button, hit the share button. It's the only thing I'll ask of you. I'll try to pour my heart into this and give you as much information as possible. All I ask is hit the like, hit love, and hit share. It helps bring other people in this. So the bottom line is just having a separate business bank account and running money through there opens up probably the majority of funding options that are available to you. And if you're still using your personal bank account to do this, you are not going to get any of the access to those opportunities. Now, selling home phone numbers will likely be used, will get your business flagged. That will trigger denials as well. So you've got to make sure that you separate that, get a business phone number, get it toll free. You can use voice over IPs. You also want to make sure that you're doing the exact same thing with addresses that you're doing with actual phone numbers. You also need to make sure that you stay away from UPS addresses, stay away from PO boxes, get a virtual address if you can't get a brick and mortar address. So you want to start to separate the personal and the business credit and separate your personal and business. You can't run your business and use your home phone as your business phone number, use your cell phone as your business phone number, use your home address as your business address. You don't want to do those things. Again, like I said, lenders and credit issuers are desperately trying to determine the businesses that are real legitimate businesses that can grow to 7 figures and above and the ones that don't. I'm not saying that a legitimate business has to do 7 figures. I'm just saying that from a lender and credit issuer's perspective, they want to look at the businesses that are the 0.5%, the 5% that grow to 7, 8 figures. And they're looking at business structure for that. They want to make sure if your business phone number is not separated, if your address isn't separated, then again, it creates issues because you're commingling these two things. It's not as serious going to get you audited in trouble, but it's going to get you denied because lenders and credit issuers don't take you seriously. What kind of business phone number is a cell phone number? Businesses or lenders not going to take you seriously with that. If you're working from home, that's fine. I'm working from home. I have a home-based office. We are an 8-figure business and we work from home. We shut down both of our offices last year because we realized we didn't really need the offices. But again, we still have a virtual address that makes us look legitimate and credible. So again, you want to really consider doing that because in doing so, that's what really separates you on the personal and business side. And again, a virtual address, Alliance, DaVinci, Regis, these separate it where you're not using your home address. A lot of us want to use our home address as our business address. But guys, Google or Dun & Bradstreet's using Google Street Views of our business on our business credit reports. Do you really want a lender or a credit issuer to pull your business credit report and see a picture of your house? Really? I mean, that's what they're seeing. And then what, do you really think that you look credible when they see that? And then you don't know why you got denied and you're like, oh, I can't get approved. Yeah, you can't get approved because they just pulled your business credit report and they saw your house with like a beat up old car in the front yard. Of course, it doesn't make you look credible, but we also have the ability to control that perception by setting it up and separating our personal and our business side. So credit providers, vendors, and the like are looking for your business online. So you got to make sure that you have that business phone number set up. You got to have that business name set up. You got to have that business address set up. You want to have a business website. You want to have a business email address, not a personal email address. It's not just separating consumer and commercial credit. It's creating everything separate from your business than you personally. Separating phone numbers, separating address, separating email addresses, separating credit profiles. You got to separate everything to really be perceived as a credible, legitimate business. Now, again, as I mentioned, people that use AOL, Yahoo, Gmail, they're hobbyists. That's what you're seen as. You're not even being taken seriously because who does? What big privately or publicly owned company are the employees sending out their emails from Yahoo or Gmail addresses? It doesn't exist. They're trying to see if you're a legitimate business or not. And when you're not doing these things, it just doesn't make you look legitimate. Now, every U.S. Secretary of State website has business information, including websites. And again, this often can include information on grants, loans you may qualify for now in the future, business licenses you have. So all of these things you want to get, especially if they're required to get, because it just helps that separation of consumer and credit. And sometimes it's even required by law. You actually have to have it to even be lawfully operating as a business. Okay. And does debt ratio affect business credit? Says Facebook user. It doesn't affect your main credit score like your Paydex credit score. So Dun & Bradstreet, Equifax, Experian offer 5 credit scores, and it will affect your financial scores, like financial stability score, your risk of filing bankruptcy, but it won't affect your main score like your Paydex score, which is just based on how you pay your bills. So yeah, debt ratio absolutely does affect your business credit scores. And Jason says, what business credit card do you recommend to help build business credit that reports to business credit but not personal? You start with vendors. Uline, Quill, Granger are some good ones. Another's Crown Office Supplies. Another is Supply Works. Those are vendors that you can use to establish initial business credit. And Nyla says, you're awesome. I appreciate it from YouTube. Good Credit America says, does that debt ratio affect your business credit? We just answered that question. Yes, it does. It affects some of your business credit scores with all 3, DNB, Equifax, Experian. So in order to build business credit, as we talked about, you've got to have a DUNS number with Dun & Bradstreet. You need to have 3 accounts reporting with Dun & Bradstreet. Jason just asked a question. How do I get initial accounts? Uline, Quill, Granger, Office or Strategic, or excuse me, I almost said Strategic Network Solutions. They no longer report. And then again, I think I mentioned Crown Office Supplies and Supply Works. Those are some vendors you can build initially to get those 3 accounts reporting. Now, your credit history is one of the main factors that lenders and credit issuers use to determine credit worthiness, and making timely payments will show that you are lower risk. But a lot of vendors don't report your timely payments to the business credit reporting agency. So you got to get credit with vendors that do, which is good that Jason asked that question because it gave us a chance to dive into a handful of those accounts that actually do. And keep in mind, Your business credit reports and scores are used for three main reasons. One, should you get approved or denied? Two, what kind of interest rate in terms should you get? Meaning term, how long of a term should you be given? That really matters to keep your payment low. What kind of interest rate should you pay? And the third thing is, how much money should you get approved for? Your business credit reports have a recommendation of credit from the Bureau. The Bureau says, here's how much money you should lend to this person. So there's a reason that that's on there, because lenders and credit issuers pay attention to it. So you have to keep in mind that your credit reports in the business are being used for those reasons. Now, again, we talked about some of these: Granger, Crown Office Supplies, Uline. You go to these vendors, you set up an account for free online, you put items in your cart, you check out, then they offer you some kind of option like Invoice Me. You check that option. When they ship the items, you pay the bill. It's that simple. Now, if you don't get credit, if they write to you and say, sorry, we can't approve you for credit right now, you need to place some orders before we will, that means you jacked up their fundability. And again, I talked about some fundability points today: your address, your phone number, your email, your website, but there's 125 factors that tie into your fundability. So check out resources like our YouTube channel, youtube.com/credit suite, for more information on fundability. The more pristine your fundability is, the more of these credit issuers are going to approve you right away without you having to buy anything from them, okay? So this is one of the easiest ways to do it. Now what happens is, once we come in and use these vendors, and we have 5 of them, we build an initial business credit profile and score. The next thing we do is we go to creditsuite.com/monitoring, and we get our credit reports. You can go anywhere you want, but they're $24 through us. It's the cheapest in the world you're going to find. Okay, I don't exaggerate. Anybody that knows my training, that's the cheapest in the world you can get business credit reports. So creditsuite.com/monitoring, you see these 5 accounts report. Then you can start getting revolving store credit. Then you can get Visa card, MasterCard, fleet credit, a lot of training that we provide to be able to build business credit. You can also go to creditsuite.com/live-checklist and get our actual checklist that will walk you through the steps to building your business credit. Now what happens is we can start to rely on that business credit more. Now, when I go get a Staples credit card, an Amazon credit card, I can start letting them use my business credit, not my personal credit. I might have to give them my social to verify my identity, but I can tell them I'm not authorizing a credit check. I'm not authorizing a personal guarantee. My business has its own established credit profile and score. You can make the lending decision based on that. You force them to pull your business credit report. They see timely payments. They see you have a credit history. They see you're using credit on a regular basis. Then they start to approve you for all of that credit without a personal guarantee and credit check. Now, keep in mind, to get loans and credit lines, it's going to take a lot of established credit for business credit to be the primary driver of those. Also, keep in mind, to get loans and credit lines, they're going to want to see your revenue. They're going to want to see your bank statements. They're going to look at other factors other than business credit. Business credit is a big driving factor to help you get approved, but it's not the only factor when you get into loans and credit lines. When you get into credit cards, business credit can be the only factor. Revenue doesn't matter. Personal credit doesn't matter. Collateral doesn't matter. So you can get all kinds of business credit cards, computer leases, auto financing without a guarantee and credit check, just based on business credit quality. To get loans and credit lines, business credit's a factor, but it's not the only factor. So some things to keep in mind as you continue to get more and more financing. So separating business and personal credit, it really matters. It protects your personal assets, okay? It protects your personal credit scores, and it really lays the foundation for business credit building as well, which in turn really helps you separate commercial and consumer credit. But it helps lenders, credit issuers, suppliers, and such really see that you have a track history of paying your bills. And then it creates a world where they want to give you money. All kinds of people have come onto these chats during my presentations and say, hey, the minute I got this, I started to get all these offers in the mail. Remember, when your business credit scores are established, when you have a certain amount of trade lines, it triggers all these credit issuers to start sending you applications for no personal guarantee credit. Applications you're not getting now because your business credit's not yet established. But once you establish business credit, all this credit starts to flood in, all these offers where you can then get it without personal guarantees and liabilities. A lot of people that start building business credit say, I don't even know where to go. And then once we show them, then you don't have to look anymore, because the credit issuers are soliciting you because they see you as one of those businesses that's going to get to 7 figures and above. They see you as that bucket of people that they really want to give money to, okay? So if we can help you along the way, give us a call, 877-600-2487. When you give us a call, we give a free consultation. On that consultation, we get your business credit reports for free. Dun & Bradstreet, Equifax, Experian, they're $249 from the bureaus. You get them for us at no cost. Only place you can get them at no cost. We go through them with you. We give you tips and tactics to build your business credit. You also, on that call, will be qualified for funding. We'll tell you all the loans and credit lines you can get now. And we do a fundability assessment to see where your fundability is off that's preventing you from getting approved. You could fix some easy things on fundability and turn around and immediately start getting approvals when you've been getting denials. All that happens on a consultation call. Give us a call, 877-600-2487. Email us, info@creditsuite.com, or go to creditsuite.com/consult to schedule your consult. Grab our checklist on building your business credit at creditsuite.com/live-checklist. Okay. And like us on our social channels. If you got value from this, like the video, love the video. I can see in real time who likes it and loves it. And I appreciate when you do. I pour my heart into this. All I ask is one thing: like and love the video. That tells the social channels this content's valuable, and it helps them show it to more people. And also share it. If you think that your network can get value, please share it. Appreciate it. If you'd like to learn more, Tuesday and Thursday at 1 o'clock Eastern and 11 o'clock on Wednesday, we go live on Facebook, Periscope, YouTube, and actually on LinkedIn now. If you're following on Credit Suite channels, you can engage in real time, and I'll answer questions as you see here. You can get to all of our social channels at the top right of our page, creditsuite.com, and listen to our podcast while you're there as well. It's got almost 400,000 downloads, or now, no, wait. I don't even know. It's a lot, like 400,000 downloads. We have special guests on that teach you all kinds of tactics to help you start and grow your business as well. And I want to make sure that I answer any final questions that you guys have. Naila, you're awesome. I appreciate that. Do you recommend Yext as Good Credit America? I like Yext. So Yext is a service where you can update your information once, and they update it with hundreds of online sources. I love Yext, but there are cheaper places that do what Yext does than Yext. I just tell you that because a lot of people complain about the cost of Yext. We use Yext to be able to update all of our records across the internet. And Kenneth says, when you say they'll look at your personal credit for a new business, are you saying they'll run personal credit or have a soft look? It depends on the credit issuer and lender. Some look at hard inquiries, some look at soft inquiries. If I'm ever going to let them, if you're getting a credit card, then again, if you built business credit, they shouldn't even look at your personal credit report, soft or hard inquiry. You didn't authorize them to. You have to give them authorization to look at your credit report if they can't. But a lot of other banks will look at your consumer credit when you start getting loans and credit lines. Whether they do hard or soft inquiries depends on the bank. But it's a good question to ask the actual funding source because it's different. And Good Credit America says, does SBA report a loan to your business credit report? It's not SBA that gives you the loan. Remember, guys, the bank gives you the loan. SBA guarantees the loan. So if you ever default, SBA gives the bank the money. So it depends on the bank is the answer to that question. Some banks will report the loans they give you, whether they're SBA or not, to the business credit reporting agency. Sometimes they don't. That's a really good question, a Good Credit America. And I ask that question to a credit issuer before I ever get credit. If I'm applying for a loan with the lender, I ask the lender, if I get this loan, are you going to put a UCC filing on my credit report? Meaning, are you going to tell other people that I have this lien by filing a UCC filing? It's not necessarily good or bad. It doesn't help you if you have a UCC filing. And I ask them, are you going to report it on the business credit report? And if they say no, I say, that's kind of shady. You're going to do a UCC filing, tell people I have the loan, but yet you won't give the person that's looking at my credit report or me the benefit of telling them how I pay. And then if I can find another lender that offers that same kind of loan, I go through the other lender. And that's why whenever I'm looking at any individual credit card or loan, I always ask that question. And if they report my payments to the business credit reporting agency, they win over another lender that doesn't, even if the other lender charges a little bit of a lower interest rate. And I tell them that. And a lot of banks lose our business because of that. I said, I just want you to know. And Capital One was one of those. You think they care about me? They don't. But I told Capital One, I said, just to let you know, we're not going to use your credit card because you report to consumer and business credit reporting agencies. Why would we? We can use these other credit cards that report to business reporting agencies. So I just wanted to let you know that we're not using your credit card, and a lot of other people won't because you continue to report my business credit, my business to all my personal credit reports, which is completely uncalled for. And I don't use them. And that's the way that I am. I don't apply for a lot of credit or use credit I get unless it's a last resort if it reports to both. I use the ones that report to the business credit reporting agencies. Okay, and Latoya says, how long after starting a new business should you start building business credit? The minute you start a new business, immediately, because it takes time to build and you can get the money through business credit to be able to fund your startup. And Good Credit America says, I actually met you at Credit Repair Expo. That was a pleasure. It was awesome seeing you two. You look familiar kind of in the vision behind the YouTube channel. But when they open back up again next year, I'll be at Credit Repair Expo speaking again. Thanks everybody for tuning in. Make sure you like the video. Please love the video and share. And then make sure that you subscribe on our channels to get notified when we go live and deliver more training on getting money for your business. Thanks. Have a great day. And I look forward to see you on our next training where we teach you how to get the most money at the best rates and terms.